What's up, guys? This is Casey, and welcome back to the channel. So today we're going to be discussing why the stock market is so hard to beat. And when I say hard to beat, I'm talking about day trading and swing trading and making tons and tons of money. Now, if you look online, you'll see a lot of channels that swear by you making 3, 4, 500% consistent profits. They tell you how to make 10, 5, 15, $20,000 a month. Just subscribe to my channel, subscribe to my forum, my feed, buy my monthly stock trading package, join my group. And you notice a lot of the times that if you ever join those groups, you don't really make a lot of money. And the reason being is that the stock market is 75% algorithmic controlled, which means that 75% approximately of all of the stocks, the trades that go forward throughout the day are through programs. And one of the biggest challenges with that is that a lot of the companies who actually control these algorithms, they have them programmed in a way to where they're artificial intelligence, and they specifically are designed to take not only the bulls but the bears' money simultaneously. One of the great uh, stock traders back in the day said that uh, the stock market is designed to take most of the money from most of the people most of the time. So it's not about your intelligence. You could have 160 IQ. It's about you're trying to take money from a computer that is designed and programmed through AI intelligence to take money from you. So just think about that. And so the challenge with that is when you take a look at some of the stocks, you will notice that the patterns of the stock markets, they trade in a way to where they set up traps on a every time frame, whether it's 5 minutes, 10 minutes, 25 minutes, hour minutes. Let me show you guys some of the things that I'm talking about here. So if we take a look at this, let's just take a look at the QQQs. I like trading QQQs. This is what I do. What you will see here is I have some of the moving averages. I have a 50, a 20, a 10, 100, and so forth. The stock market is designed in a way that if you're trying to trade, say, like the 5 minute time frames, right? Well, if you take a look at this and we just scale in, a lot of the people, they like, the stock market knows the price points that people want to purchase at. And so you will notice that maybe you want to purchase here at the 5 minute. Well, if you notice, it goes pops through and it doesn't complete. Maybe you want to purchase here on the rebound. Okay, great. This is another rebound, but it doesn't continue through. And so what you'll see is you'll see a lot of the times that stocks just don't have follow through. Or what you'll find a lot of the times is you'll see situations like this. You've been watching, the stock market goes up, it pops, you're like, oh yeah, time to make some money. We got that nice pop we're looking for. And then you get caught in this, and then it sells off, and then you're stuck and you're trapped, and then you panic, and then you sell. You're like, oh my God, I'm going to get trapped. All my money's going to get taken. My money's going to get taken just for it to turn around and rebound, and then for you to be green, only to be upside down again. And so understand that the algorithms they're artificial intelligence. The companies who have designed these are very secretive. They developed these 20 some odd years ago. They're continually developing them, tweaking them. A lot of the people who even developed them, the quant traders, don't even fully understand how they work. But just know that they're very, very smart. They're very intelligent. Another challenge that you have as well when you're day trading is a lot of people like to trade based on news. So if you look on, like, some of the top financial channels, I'm not going to name them, but I'm sure you guys know what they are. It's only a handful of them. A lot of them will make their trading decisions based on their recommendations, and then they have to say aren't recommendations, right? So they'll say, for example, the major tech stocks such as Netflix, is really having a problem, and subscribers are canceling. Oh my God, I want to go sell my Netflix stock. So people go out, they run out, and they panic, and then 2 weeks later, Netflix earnings comes out and turns out that they're actually crushing it. And then all of a sudden, if you take a look here, Netflix is now rebounding. If you take a look up here, when you were looking at Netflix, they were saying subscribers, people, hashtag cancel Netflix, yada, yada, yada. Oh my God, it's going to go to zero. And now it's kind of slowly rebounding. Does this mean it's going to go back up? Not necessarily, but it's about not trying to trade on news. So the first problem you have is or the high frequency traders, the algorithm traders. These stocks, these softwares are designed to trade against bulls and bears at the same time, and they purposely and intentionally set traps at every time frame. So a lot of the times when you're looking to buy, when you see a stock rebounding, it's just a trap. Or maybe when you're looking to sell, because you think that the market is going to just fall to the floor. Let's say, for example, something like this here, although this would be a good point to buy, well, then it rebounds. Only then to turn around and to continue to retest and retest before it eventually will then break down again. So you have the high frequency traders, you have high frequency trading, that's an issue. You have trading off of news, that is also a trap. And then you have something in terms of equilibrium, and that is that the stocks are always constantly looking for ways to find the perfect balance of what is the fair market value. Now, one of the things that people don't understand, this is something that even a lot of professional traders, which I am not, don't fully understand and or think about on a continual basis, is that the actual stock of a company is not the real valuation of what that company is. So look at it more like, these are more like side bets of what people think that a stock is worth. Now, yes, they are doing it based on tangible things, fundamentals such as, companies' earnings and their balance sheets and things of that nature. But it's not a direct correlation of what a company is actually valued at. And he's like, well, how can you say that when it goes based on the market cap? And the reason being is because you will notice that the stocks will trade and sometimes in opposition of what a company is actually valued at a lot of the times. So you will say, well, this company's making lots of money. They have great earnings per share, but the stocks are down. Or maybe you have a really good growth stock that is not necessarily making money, but they're one of the industry leaders, let's say like a Shopify, and there aren't really a lot of, online news template-based, start your own company type companies, but you take a look at it and Shopify is down $43. And it's like, well, you look at something like this and you think, well, did their earnings fall that much? No. Did their business model change or something drastically change with the company itself? No. Are they in financial trouble? No. So why did the stock go from 222 to $38? Well, there's market conditions. There are people concerned about recession. There are people concerned about the overall stability of the markets. There are people concerned about the interest rates, with the Federal Reserve, with the amount of capital. One of the things you guys have to understand when it comes to investing, or I should say stock trading, is that you have to know the stock that you're trying to trade. It is a big difference between trying to trade, say, Shopify, and let's just say an Apple. And why is that? And the reason is because of the market capitalization. Apple is a lot harder to trade. When I mean harder, I mean in terms of move, because they're a larger market cap company than, say, a Shopify that is significantly smaller. So let's take a look at something. I wanted to show you the market cap of Apple, and it was over $2 trillion. I'm not quite sure where it is as of today, but it's pretty significant. Whereas Shopify is like a 50-60 billion dollar company, significantly less than would say, an Apple, or let's say an Amazon, or let's say, I don't know, so for example, let's look at Amazon, right? So Amazon, the revenue is excellent. Amazon we know it's a staple. We know it's one of the top companies in the world. It's definitely one of the top retail companies. But if you actually take a look at the chart, it has just been falling through the roof. On the weekly, you go from the highs on the 187 down to an 84. Look at it. It's fallen significantly. Why is that? Again, interest rates, market conditions, things of that nature. These are all concerns, and these are the reasons why the stock market is not a direct correlation of an actual value of a company. So you have the algorithms, you have the issues with the market cap size, you have issues with people trying to purchase and buy off of news, and then you also have the time dilation game that I consider, and this is one of the big ones. The stock market knows that people want to buy stocks and make money quickly. Everyone wants to make money. Who doesn't want to buy a penny stock and then it jumps 600% in a week? Like, it knows that. That's human nature to want to buy something and go up fast. So what does the stock market do? What does Wall Street do? Is they slow play it. And one of the things you got to understand with the stock market is that it purposely moves slow. It doesn't make money. It doesn't go up 10, 20, 30, 40% in a year. And this is the trap that a lot of people fell into when we go back and look at the QQQs. Or let's go back and take a look at the SPY. A lot of people and I mean a lot, especially retail. You go back and take a look at let's just do the monthly to make it simple, right? Everyone was buying stocks here back when we had the pandemic. I mean, people who had never gotten into the stock market before, and they're like, oh my God, everything I'm buying is just going up and up and up and up and up. I can't stop making money. I'm going to get the stock market. Why didn't I know this before? I put in 5,000, they're putting in PPP money. They're doing all sorts of shady, illegal stuff that they're not supposed to be doing, just making tons of money. Wall Street knows this, right? I mean, everybody was eating during this, we call it a bull market, I guess. I mean, it was kind of weird, right? Because we thought the world was going to end, and then all of a sudden, it's all new highs of a bull market that we've never seen before. If we go take a look, actually, I'm sorry, that was 2008. Let's try that again. Here, the statement still stands, right? So take a look here. The SPY went from 246 up to 471, and this is from 2020 of March, basically April. March, April of 2021. So we're talking about a year and 8 months. The stock market went from $238 to $472. That's like 80% in a year. The stock market on average goes up about 10 to 12% a year on average. And this thing went up 80% almost. So people are thinking, I'm going to make tons of money. This is not how the stock market goes. If we pan out, and we go all the way back to, I don't know, pre-2000 days, right? The stock market has only ever really done that. Let's see, what do we have in 1994 to 2000? So that was a 6-year period where the stock market went from $40 to 122. So it went up like 140%, somewhere around there. But even that was over a 6-year period, right? We then had the 2000, .com bubble, which most of you guys probably don't remember, or maybe you do, depending on how old you are. If you're Gen Z or Gen Y, you don't. $120 to 64, it fell 50%, but even that took 3 years, only for it to rebound from $67 to 120 over a period of 4.5 years. Okay, so if you notice, the stock market does not move up this drastic, this aggressive. You just look at the chart. And so the problem that we have now too is that a lot of people remember this. They've only ever gotten into the market in this time. And they're like, okay, well, this is how the market's going to be. I promise you, it will not be. Not only will it not be, we may not see this again for another 10, 15 years. And the reason I say that is because Wall Street knows that retail wants to hop into the market. They're not your friend. Their job is to trick you, trap you, and trade you. And no one does it better than Wall Street. And so a lot of the people are trapped. And let's use ARK, for example, right? The darling ARK. I mean, you go back here in the 2020, 45, 130, just tons and tons of money. You know how many people are trapped upside down now, right now? Lots of people. ARK people are trapped upside down in. Shopify people are trapped upside down in. Twitter is another one. I like Twitter, especially that Elon Musk is taking it over. We're not having a political conversation. Just saying, I like the fact that, it's a good platform. Can it be a little bit toxic every now and then? Yes, it can be. Can every platform? Yes. But if you take a look at this, a lot of people bought Twitter because it's a darling, social media. Well, look at it. It's fallen $75 to 36. I mean, a lot of people are trapped upside down in this right now, and Wall Street knows it, and they're not going to let you out easy. They just aren't. So I digress. Why is the stock market hard? It is hard because Wall Street knows that everyone wants to make money and they want to do it fast. We also have the issue that people have not actually thought about their risk tolerance. Every stock has something called a beta. And the beta is the volatility relative to the index. So let's say, for example, Apple may have a beta of like 0.90. 1.0 is a beta of 1.0 means that it has the same volatility of the index. If you take a look at, say, like I guess we'll use Shopify again, it'll have a significantly higher beta because it's more volatile. It moves more aggressively, ups and down, when it comes to actually making money. And so you have to have a risk tolerance of being able to buy, say, and again, I think Shopify is a great company, but you have to have a risk tolerance of purchasing Shopify and then knowing that you may be upside down 50, 60, 70%. And now you have to ask yourself, okay, man, I'm upside down 60, 70%. How long do I wait before I just cut bait? Well, a lot of that depends on how much are you in Shopify. And I'm just using that as an example. A lot of people have a problem where they want to purchase, they want to use their entire liquid portfolio in one or two stocks. Now, that does make sense in a bull market, but it doesn't in the kind of conditions that we're in now, because the conditions that we're in now is we're kind of in no man's land. And so a lot of people want to go and purchase, let's say they use their whole $5,000 in a portfolio. I'm going to go put it on Tesla because I love Tesla and blah, 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 blah. Okay, great. Well, you did that. Let's say you saw it here. Let's say you saw it, anywhere here, right? You're buying this. You put $5,000, $6,000, $7,000 in Tesla in 2022 because everybody's making money. You want to buy the pullback because that's what we're doing. Oh my God, it's going to go back up more. Money, money, money. Nope, no money, money, money. You bought here at 290. Look at this. You're still down 35, 40%. And you had to tolerate it being down 65, 70%. And you had to watch this over a period of 12 months, 4, 6, 7, 8, 9, 10, 11, 12 months. Do you have the stomach for that? Most people don't, especially if you're trading with money that you need, right? This is why the stock market is a game that where people, you want to invest money that you don't need. Because if you put money into the market that you need, there's a high probability that you're going to be watching it every day. You're going to be super emotionally attached to it. And you're going to start to see the stock market go down over a period of a few weeks or a few months. And the next thing you know, you're going to sell out only for it to turn around and rebound again. And so Wall Street knows this. And that is why it gives enough time for people to get trapped. It gives enough time for people to try to buy the bounces, only then to be upside down. It gives enough time for people who want to try to do this, play the short game, right? You want to try to short stocks that have been, going up a little while, and then get caught, and then next thing you know, you're upside down from shorting, right? So the Wall Street wants people to lose patience. It's phenomenal at losing patience. And the shorter time frame that you have to where you're trying to make money, the more likely it is the Wall Street can take your money. So if you're trading with money that you need, that you don't want, or that it's just not trading money, if you're highly invested, if you're highly leveraged, you can forget about it. A lot of these algorithms, they know and understand support and resistance levels. They know where people want to buy stocks. They know where people want to sell stocks. And so what you'll find a lot of the times is that it will turn around and it will purposely and intentionally hit your stop loss, only then to turn around and then run up again. It does that consistently, especially on big run-ups. Right before it does a quick run up, it'll go and do a quick, stop loss hit. Let's take a look at this, for example. Let's look at Amazon from 19 all the way to 20, from January to January. So basically about a year, did nothing. Started to fall. Like, oh no, it's going to start cropping out again. It's psych, and then it shot up. So this is why day trading is so difficult. This is why people are selling packages, because they know it is almost impossible to do this. A lot of day traders don't even make money doing this because it's just so volatile. So how do you make money day trading if you wanted to do this? Well, I can't exactly tell you how to do it successfully and consistently, because everyone has to be responsible for their own investment patterns and tolerance and things like that. And so I can't speak for you specifically, but I can give you some recommendations on what to do so that you're not caught and that you protect your downside risk. You have to remember that when you're dealing with day trading and or swing trading, your downside risk and protecting that is actually more important than your upside risk. Let me say that again. Your downside risk is more important than your upside risk. And the reason I say that is because you have to make sure that you're invested in a stock and or ETF to where you have a 2-to-1 ratio of making money, and to where you're willing to accept it going down a certain percentage before it goes up again. Almost never almost never will you ever buy a stock and you're not in the red before it goes up. I'll say that again. Almost never will you buy a stock to where you're not in the red before it goes up. Even if you perfectly try to get the market and you time it to where it's going to have a rebound, let's say you're like, oh, look at this here. I think I finally, figured out Amazon. It's going to rebound. I got it going above the 10-day moving average. Great. Guess what? You're in the red again, just 4 or 5 days later. Now, more than likely, and look at this, and you're in the red all through here. So you have to remember to have patience when you're day trading and or swing trading, because you're going to be in the red. You have to remember to you understand your risk tolerance. A lot of people online are looking to try to buy stocks that are penny stocks or low cap stocks that make 200-300%. Listen, you will make lots of money with that, but only in bull markets. Do I think that we're in a bull market right now? I do not think we are in a bull market right now. We have the Federal Reserve that is still raising interest rates. We have companies that are still doing layoffs, especially in tech right now. And we have a lot of uncertainty with the real estate market because housing prices have gone down significantly, 20, 30, 40%. And we don't know if they're going to continue to go down more. And so all of this points to a factor of we don't know what the market conditions going to look like over the next 3, 6 months to a year. But one thing I will tell you guys is follow the Fed. Whether you're day trading, swing trading, investing, it doesn't matter. The Fed runs the show, okay? They run the show. And so right now, the Federal Reserve is saying they're still tightening. They're still raising rates. They've slowed down the rate raising, but they're still raising it. And so what that means is that companies are still tightening their belts. That means that the cost of borrowing money for companies that you want to go up, that you want to have higher earnings per share, that you want them to have more money so that you can make money buying the stocks, that means that they're still scaling back, which means that we're probably in a stagnant period for maybe the next year or two until the market conditions can flush out, until the Federal Reserve can get close to the 2% interest rate that they want to be at. And then once that happens, we can then start, looking at buying some of these growth stocks, some of these tech stocks, based on their earnings, their balance sheets, and or stocks that we just like. So that's pretty much it, guys. I hope you enjoyed the video. If you did, please make sure you hit the like and subscribe button. So I am doing something new today. As you guys can tell, I'm doing more of the visual interactive video. I've had some requests of this. I've been a little bit apprehensive about doing it, but if I get some positive reviews and comments that you guys like this format more, then we'll just continue to do this more often. And also make sure you leave in the comments below some of the things you'd like me to talk about. So it doesn't also have to be just about stock trading. It can also be about just individual stocks themselves. It could be about the Federal Reserve. It could be about just overall investing, which is what we talk about here. So let me know what you guys think. Thanks for watching the video. If you got to the end, hit that like button, and I'll talk to you later. Take care.